Hello, welcome. This is Dr. Nunez. We're going to work on the Chapter 2 homework assignment for this session, and hopefully you'll get the tools that you need to complete the Chapter 2 application assignment and the Chapter 2 quiz. Let's start by reviewing the debit and credit rules. So again, the basic accounting equation, assets always equal the liabilities plus the equity and debits on the left, credits on the right. And it doesn't matter what kind of an account you're talking about. Debits are always on the left and credits are always on the right for all assets, all liabilities, all equity, all revenues, expenses, and dividends. Now, a debit increases an asset and a credit decreases an asset. Liabilities and equity are just the opposite of assets, right? Because a debit will decrease a liability and a debit will decrease equity, but a credit will increase liabilities and a credit will increase equity. Also, revenue is a lot like liabilities because revenue is a subdivision of equity. So if we want to increase our revenue, we should be crediting it. And if we want to decrease revenue, we'd have to debit it. And expenses and dividends, well, they're kind of like assets in terms of how we increase or decrease them because they reduce equity. So if we want to record an expense, which in effect decreases our equity, we would debit it, right? Because debits decrease equity. If we want to reduce our expenses, then we would credit them. And same thing with dividends. Dividends represents an outflow of cash, an outflow of earnings in the form of cash, and that in effect reduces equity. And the way we reduce equity is by debiting it. So we would debit dividends to increase it, which would decrease the equity. So the first exercise that we're going to look at here, BE 2-1. So we need to talk about these accounts that were given. And for each account, we need to be able to determine whether the account is more likely to have debit entries only, credit entries only, or both debit and credit entries, and then what's the normal balance. So let me also point out here that the debit side is always the the debit side is always the increased side for assets, right? Because assets are increased with debits. So this is the increased side, and this is also the normal balance. So debits increase assets, and that is the normal balance of all assets, right? So all assets are increased with debits, and that's the normal balance. And all liabilities are increased with credits, and that's the normal balance, right? And equity, all equity accounts are increased with credits, and that's the normal balance. So here's what you need to keep in mind. Whatever the increase side is, well, that's going to be the normal balance. Assets are increased with debits, they're normally going to have a debit balance. Liabilities and equity are increased with credits, they're normally going to have credit balances. Revenues are increased with credits, they're normally going to have a credit balance. Expenses and dividends are increased with debits, they're normally going to have debit balances. Okay? So with that in mind, let's get started with BE 2-1, and I'll leave those debit and credit rules up there for just a few minutes. So when we look at accounts payable, what's true of accounts payable? Well, accounts payable, we could very well have both debit and credit entries. Why? Well, because when we increase our accounts payable, we're going to be crediting them. And when we pay our accounts payable, we're going to be debiting the account. So accounts payable is going to have both debit and credit balances because we'll be increasing and decreasing the accounts payable. So it's going to have both debit and credit entries, right? That's what I meant to say. The accounts payable account will have both debit and credit entries. Now, normally though, it will have a credit balance. So what I'm doing here is I'm listing first whether it's going to have debit or credit or both, and then the normal balance I'm listing over here. The normal balance is a credit. Right? The normal balance is a credit. So we should see accounts payable having both debit and credit entries, but the normal balance is a credit. When we look at the cash account, Well, cash, when we receive cash, we'll be debiting it. When we pay cash, we'll be crediting it. So cash is one of those accounts that, again, it's going to have both debit and credit entries. But normally, well, when you get to the end of the period, normally cash should have a debit balance, right? It should normally have a debit balance. And then dividends. Well, dividends, look at dividends. Well, generally, when we record dividends, we're going to be debiting that account. That's how we record dividends. And so typically you're only going to see, debits in that account. There really is no reason for normal transactions for us to be crediting the dividends account. So in this chapter, all we're going to see really are debit entries into the dividends account. And of course, if that's how we increase the account, then the normal balance is going to be a debit balance. And when we look at miscellaneous expenses, well, expenses are just like dividends, right? We're typically going to be recording expenses. And so in most cases, we are only going to be debiting our expenses, right? So we would typically see debit entries for those transactions. And that increase side for expenses, well, that's the normal balance. The increase side is the normal balance. So we should see a debit balance. And all expenses are the same, right? Doesn't matter whether we call it miscellaneous expense or insurance expense, it's an expense. So all expenses are going to behave the same way. So we should see mostly debit entries into the insurance expense account, and we should normally see a debit balance in the insurance expense account. And revenue is just the opposite, right? When we look at revenue, well, typically when we're recording revenue, we're going to have credit entries, and that's what we'll be seeing in that fees earned account. We will typically be seeing credit entries. And that increase side, that credit side is the normal balance. We should see normally a credit balance in the fees earned account. So that's just a little bit on the debit and credit rules for these accounts. Let's move to the next exercise, BE 2-2. And again, I've got the debit or credit rules listed here, so you have some sense for them. And let's start using those rules again. And this time we'll use the rules in BE 2-2. So what we've got going on here is we need a journal entry to record the purchase of office supplies. So on February 13th, we have the purchase of office supplies. So what's happening is we're buying these supplies. Supplies is an asset. And now we have to increase this asset. The way you increase an asset, of course, is by debiting it. So we need a debit to the supplies account. And that debit is for the 3175. And next, well, how are we getting the supplies? We're paying cash. So we're paying cash, which means cash is flowing out. Cash is an asset. How do we decrease an asset? By crediting it. So we want to indent our credits, and we've got a credit to the cash account. And in this case, we are only paying $1,000. So we are buying these supplies that actually cost $3,175, but we're only able to come up, if you will, with $1,000 in cash. What happens to the rest of it? Well, the rest of it we promise to pay on account, right? The remainder is on account. That's an account payable, right? Accounts payable is a liability. The way we increase our liabilities is by crediting them. So we should see here a credit to accounts payable, right? And accounts payable is going to be for the difference. It's going to be for the 2,175. For the 2,175. And that's our entry. So it's this is technically what you call a compound entry, which means we have more than just one debit and one credit. In fact, we've got one debit and two credits. So we record the increase in the supplies account by debiting it. We record the decrease in the cash account, that asset, by crediting it $4,000. And then we also recognize that we've got the accounts payable for 2175. That's the balance of the amount that we owe. Now, what's next? Well, next in BE 2-3, we've received some cash for services that we've rendered. So we've got cash. Well, the way we increase cash, because we've got cash and it's an asset, is to debit it. So that means here on October 19th, right? On October 19th, we want to recognize that we've got the cash, right? And again, the way we increase cash, which is an asset, is by debiting it. We want to debit it for the 8774. And what's it for? Well, it's for services, right? We've performed or we've provided some services. We've earned this revenue. We've got to record the fees earned, indent our credit, and we've got our fees earned. And let me go back. Let me tie this back to the revenue account. So we're recording revenue. Fees earned is a revenue. The way you increase revenue is by crediting it. So we're recording this fees earned. And then we want to recognize that the credit to this account is the 8774. And that's the transaction to account for receiving cash for services rendered. Okay. Next, we had dividends. Well, dividends, when we pay a dividend, it is recorded in this dividends account, which comes under equity. And a dividend is a distribution of our retained earnings. And so it decreases equity. The way you decrease equity is by debiting it. So when we record a dividend, we're going to have to debit it. And we're paying that dividend in cash. Cash is an asset. The way you decrease an asset is by crediting it. So on May 20th, we want to recognize that we've got dividends, right? For $75,000, $75,000 worth of dividends. And we are paying the cash, indent that credit, and we've got the outflow of cash, decrease that asset account for the $75,000. And we've recorded this distribution of our dividends. Okay. Now, next we get a chance to look at several different kinds of transactions in exercise 2-7. So we'll account for the transactions and we'll do it again in the way that we've been doing it. Analyze the transaction, determine the effect on the assets, the liabilities, the equity, and the divisions of equity, record the transaction, and then we will move on from there. And that's all we really need to do is record the transactions in a journal, and we don't need any explanations. We're just going to record the transactions. And I've got a separate sheet here with these transactions for January 1 through January 31 listed side by side with the journal. Now I can't show the entire debit credit rules, but again, what I want you to start doing is committing these to memory, right? So I'll emphasize them, but you need to have them committed to memory. So the first transaction, we're paying rent, paying rent. So we've got to recognize this rent expense, right? So January, January 1, that's our first transaction. On January 1, we want to recognize that we've got rent, the way you record an expense, any expense. So every single expense you record in this chapter, you're going to report it by debiting because expenses decrease equity, and the way you decrease equity is by debiting. So we debit this rent expense. And the rent expense is for $3,000. And then we are paying the rent in cash, indent that credit, and cash is an asset. The way you decrease an asset is by crediting it. So we're going to credit that cash account for the $3,000. Next, we have advertising expense. That's on the 4th. So again, another expense. Well, all expenses that we pay for in cash are going to look the same. So, and that should be the 4th. if we have another expense here, and this time, well, this expense is just called advertising, all right? Record an expense, which decreases equity. The way you decrease equity is to debit it. So we debit the expense for 2,500. And we're paying in cash. Again, indent that credit to show the decrease in the asset called cash for 2,500. Okay. Next, we are paying on January 5th for supplies, paying cash for supplies. So we are buying supplies. Supplies is an asset. The way you increase an asset is by debiting it. So we're going to debit the supplies account. How much? $1,800. Debit the supplies for 1,800, and we're paying cash. Indent that credit because we want to reduce that asset called cash. The way you reduce an asset is by crediting it. So credit the cash account for $1,800. Next, we're purchasing office equipment on account. So now in this transaction on the 6th, we're buying this office equipment, but we don't have the cash. We are promising to pay the account, right? So we are buying the equipment on credit, right? It's on account. That's on credit. We have to record that liability. So the first thing we need to do is recognize that we've got an increase to our assets. The way you increase assets is by debiting them. So office equipment, right? For $13,900. And again, we're not paying cash, don't have the cash. Instead, we're buying it on credit. We call this liability accounts payable. When we buy an account, it's an account payable. So we credit this liability. The way you increase a liability is by crediting it. So $13,900 for the purchase of that office equipment on account. And then on the 12th, we are receiving cash from customers. How do we show an increase in an asset like cash? We debit it, right? Debit that cash account for 14,770. And it's on account. So we've got customers that have purchased from us on account. That means that they asked for credit and they owe us money. And that gets recorded in account receivable. So we have this asset called accounts receivable. And now the customer is paying on their account. We've got to reduce that asset. The way you reduce an asset is by crediting it. Indent that credit and it's accounts receivable for 14,770. Next, on the 20th, we are paying on account. So if we link this back to number 6, for example, when we purchased this office equipment on account, we recorded that liability by increasing it. Now we have accounts payable that we are paying. So we've got to recognize a reduction in the liability. How do you reduce the liability? By debiting it. So accounts payable for 1475. And the cash is flowing out. Indent that credit. Decrease the asset by crediting. Got that cash account on the 20th for 1475. And on the 27th, now the 27th, what's happening is another expense. Again, when we pay an expense in cash, well, they all look the same. We've done this before, right? The first couple of things we looked at, payment of expenses in cash, debit and expense, credit cash. Same thing here. If we're paying for miscellaneous expense, we've got to record that expense. Expenses decrease equity. The way you decrease an equity account is by debiting it. So that. So on the 27th, we have this miscellaneous expense. And the miscellaneous expenses are for 700. And we're paying in cash. Indent that credit. Credit the cash account for 700. And then we're paying our utility bill on the 30th. So again, another expense looks just like the last few, right? But now we're just going to call it something different. It's utilities expense, right? For 610. Record that expense. The way we increase our expenses is by debiting them. And we're paying. Indent that credit to show the reduction in the cash account with a credit. Credit cash for 610. And we've got some fees. On the 31st, we've earned these fees, right? We've billed the customer and we've earned them. So we got to record them, right? Now, we don't have the cash yet. We just billed the customer. So the customer has promised to pay us. And this is one of those items that's on account. But this time it's accounts receivable, right? It's the customer's obligation to pay us. The customer owes us 37.3, right? And we want to recognize that we've earned some revenue. How do you increase a revenue account? With a credit. And we're going to credit that revenue account. Fees earned for 37.3. And the next to the last one on the 31st again, we are paying utility now. On the 30th, we paid the heating bill, utilities expense. On the 31st, we're paying the electricity bill. But it's the same thing. It's another expense, and this time, again, it is for utilities, right? But it's $900. Record that expense by debiting it for 900, and we are paying in cash. Show the reduction in that asset, indent the credit to the cash account for $900. And lastly, payment of dividends. We saw this a little while ago in the previous exercise. On the 31st, we want to recognize this distribution of our earnings. The way you decrease equity is by debiting it. So we're going to debit that dividends account for $800. Cash is flowing out. We've got to show the reduction in that asset called cash by crediting it. $800. Okay. So every transaction, you want to analyze it. You want to think about which accounts are affected. How are those accounts affected? And you should be able, at this point, to start linking it back to the basic accounting equation and our debit and credit rules. Which accounts are affected? Assets. Well, increase them with a debit, decrease them with a credit. Are liabilities affected? Decrease with the debit, increase with the credit. So the starting point really is making sure that you understand the transaction, what accounts are affected, how those accounts are affected, and then translate those effects into the debits and credits for the appropriate accounts. Okay? I've got a couple more left. So the next one that we're going to look at here is exercise 2.9. So same kind of thing. We have some transactions, but in this case, we're going to expand it a little bit. We're going to record the transactions again, but in addition to recording the transactions, we are also going to post the transactions to the ledger account so that we can see the recording of those transactions in the ledger account like we did in the illustration problem for chapter 2. So let's account for the transactions and then we'll post them. And we only have 4 transactions to post here. So again, I've reproduced the transactions on the same page as the journal, and then we have the T accounts at the bottom. So we're going to do all the steps on this page. So first thing we have is we're billing customers for these fees that we've earned. So on January 1, we're billing customers. That means that we don't have the cash. That's why we're billing them, because we want them to pay us. So we have the customer's promise to pay. That is called an account receivable. So it's an asset. We increase that asset by debiting it. by debiting it for the 88,500. And we've earned these fees. We've got some revenue. And the way you increase revenue is by crediting it. So fees earned for the 88,500. And now we've got some supplies. So on the second, we've purchased some supplies. We've got an asset that we need to show an increase in. So the increase in this asset that we call supplies, the way you increase an asset is by debiting it. Debit it for $3,000. And we bought the supplies on account. So we haven't paid for them yet, but we've given our promise to pay. We call that liability in accounts payable. The way you increase a liability is by crediting it. So accounts payable for $3,000. And next to the last transaction on the third, we've received some cash. Cash is an asset. How do you record the increase in an asset? By debiting it. So we're going to debit that cash account for the 66,275, and it's on account. Our customers are paying their bills, right? So we've got to reduce that asset we call accounts receivable. The way you reduce an asset is by crediting it. For the 66,275. And lastly, we are paying our creditors on account. So we have an outstanding obligation, kind of like the transaction in number two, right? We bought something, we bought it on credit, we recorded the liability in an accounts payable. Now we're paying on our account, right? So the way we reduce a liability is by debiting it. So we're going to debit that accounts payable for 1950. And we're paying in cash. Got to show the reduction in that asset by crediting it. Credit the cash account for the 1950. Okay, those are all the transactions. So I've recorded the 4 transactions in the journal, as you see there. And now what we also have to do is we have to post these transactions to the appropriate accounts. So I've already set up the T accounts, right? Cash, supplies, accounts receivable, accounts payable, fees earned. How do I know that those are the accounts we need? Because that's what the problem says. The problem says post to these T accounts. So I've set up the T accounts. I've recorded the transactions and I've set up the T accounts. Now we're going to post to those T accounts. So remember, posting just means we're transferring from the journal now to the ledger accounts. First transaction on January 1 is a debit to accounts receivable. And I'm going to record the note so that we can link back. On January 1, we've got a debit to accounts receivable for $88,500. There we go. $88,500. And we've got a credit on January 1 to fees earned, and that is for $88,500. And again, that is for number 1. So now we've posted the debit to accounts receivable, right? And we've posted the credit to fees earned. And now on the second, we have a debit to the supplies account for $3,000. A debit to the supplies account for $3,000. And I've posted the debit, and we have a credit to accounts payable for $3,000. Credit to accounts payable for $3,000. And that is on January 2nd. And I've posted that second transaction. And then on the third, we have a debit to the cash account. A debit to the cash account for $66,275. And we also have a credit to accounts receivable for $66,275. And again, that is number 3 or January 3rd. And then lastly, on the 4th, we have a debit to accounts payable. This debit on the 4th to accounts payable is $19.50. and a credit to the cash account for $19.50. And that is on January 4th. And that's it. I have posted all four of those transactions to the T accounts. Now, just for experience, we'll go ahead and calculate the balances in those accounts. So let me switch to my pencil here. So if we want to know what the balances are in the accounts, assuming that we don't have any beginning balances, the supplies account has a balance of 3,000, right? There's only one transaction, so that's the balance. The fees earned account, well, has a balance of 8,500. That's a credit. And the accounts receivable, accounts payable, and cash, well, we have to balance those accounts, right? So if we want to know what the balance is in accounts receivable, it's the 88.5, right? Minus the 66,275, right? So this larger number minus the smaller number results in a balance here of 2, 2, 2, 2, 5. That's our balance, right? So the balance in that account, right? So again, you want to think of that as the balance in the account. And again, all we're doing is we're netting the debits and credits. Accounts receivable is an asset. Assets normally have debit balance. So the debits are almost always going to exceed the credits. Now, accounts payable is a liability. We're normally crediting that account. It normally has a credit balance, so the credits are going to offset the debit. So in this case, the 3,000 minus the 1950, we end up with 1050. The balance in this account is 1050. That's our balance. The balance in this account is 1050, the 3,000 minus the 1950. And then lastly, the cash account. Cash is an asset. Assets normally have a debit balance. So the 66,275 minus the 1950, we end up with 64,325. That's the balance in that cash account. Right, so the balance in the cash account, an asset, normally has a debit balance, and this cash account has a balance of 64324. So we've done everything required in this exercise. We recorded the transactions in a journal, and we posted the transactions from the journal to the ledger. And again, that is exercise 2-9. Exercise 2-9. And that's it. That's all that I'm going to be covering. And that's enough, right? Everything that I've done here should give you the tools that you need to do the application assignment and the quiz. So everything that you need to do in the application assignment and the quiz, I've done here in these exercises. So you want to go back, you want to go through them and use what I've done to proceed with your application assignment and your quiz. Only the numbers are different, but the exercises otherwise are pretty much the same. If you need anything, don't hesitate to reach out to me. Take care. Bye.